which is the fifth model is upside without downside. So I also call this playing the bubble. So what happened in the in the late 90s, the dot-com boom was on in a big way, and everyone thought it's going to be transformational, it's going to change everything. So these companies like pets.com, etc., they had huge valuations. Even Amazon was a huge valuation, Yahoo, all these companies. Now, I had spent some time in technology. I knew that the internet was important, but I also could not tell which company would make it, which company would not make it. And I was definitely not interested in buying anything which was even trading at 10 times earnings. I like to buy things at 3 times earnings, or even better, like Fiat, 1 times earnings. That's even better. So I was not interested in buying these businesses. But there was a bank in Silicon Valley called Silicon Valley Bank, really good bank. And it was a normal bank, except that they had one thing. What they did was, see, in Silicon Valley, what happens is that if you are a landscaper or a gardener for Google, they'll give you stock options. If you are a chef for Google, you'll get stock options. If you are a waiter in a restaurant, they'll give you stock options. Stock options is like breathing in Silicon Valley. So this company, Silicon Valley Bank, whenever they made loans to all these .com companies, besides getting all their loan terms, they always got warrants. And the companies didn't care. They gave them warrants. So every time they would do some loan or some deal, they would get these warrants from these .coms. And they never disclosed how many warrants they had, what warrants they had, what the strike prices were. No disclosure. They only said that we just get warrants. So there was an unknown element to what these warrants were worth. But the bank itself was trading at a very low valuation, just slightly above book value, and a very well-run bank. Even now it's in existence, it has done well over the years. So I said, okay, this is the way to play the bubble, which is buy Silicon Valley Bank, and if those warrants turn out to be useless or worthless, we don't lose any money. We still have the bank. And if they turn out to be something, then we have a huge run. And basically, I think we had a 2.5. We made about 2.5 times our money in 2.5 years on the stock. And if I had held it a little bit more, another year, I would have made 5 times the money, because then they disclosed the warrants just as the 99, 2000 bubble was peaking, and then they started selling those warrants. So they monetized them, which worked great.